We're at the highs of the day. We had the Fed chair speaking today. Market took a little bit of a dip right about then, but it's recovered and recovered quite nicely. So we're green across the board for the majors. Yields slipping down. Look at that. 425. 425, Weiss, the yield on the 10-year. So Powell said exactly what I think we would have expected him to say. Maybe the market got unsettled for a second and then realized that it was really nothing new. Premature to say the Fed's sufficiently restrictive. Policy is well into restrictive territory, though he came back and said next. Fed moving carefully. That's been the language that's sort of soothed the market of late. Carefully, patience, those types of words. And the stock market looks pretty good as we start December.
Yeah, this is one of those situations where sort of mediocre economic news, if not weakening economic news, is now good news. So you see that in the 10-year now. The ISM number was a little disappointing. It's in contraction territory below 50. So the market's keying off on that and believing that's going to be what's going to force the Fed to think about easing sooner than they have been alluding to. And of course, as you mentioned, you got nothing additionally hawkish from Powell. You got the same party line, which has been consistent with most of the Fed speakers this week. So I do believe that I'm actually, I wouldn't say I'm surprised today. I'm surprised there isn't a little bit more of a digestion period for last month.
We've kind of had that over the last,
last couple of days,
4 or 5 days or so. It's felt digestive in that, we were kind of quiet. Right. The action was a little muted.
But even though just dialing back the massive momentum for last month is digestive period. So I still think we can rally into year end. So, and that's sort of how I'm positioned. Next year will be a different story. I'll reassess then. But for now, I think it's green lights.
Tony Pasquarello, Goldman, we always try and cite his notes when he puts them out on a Friday. Says there's a little more gas in the tank too. For December. The market's already taken credit, he says, for the good news that's in hand. And turn the bars higher. It'll be very difficult to sustain the degree of upside convexity that we've seen of late. So risk reward today is very different from what it was a month ago. However, I think there's a little more gas left in the tank for December. Seems to make sense. What do you think, Jim?
Let me start by saying the sun is shining, and I totally disagree with Steve. I don't think that the 10-year is at 425 because the economy is weakening. Certainly, actually, the ISM survey today was bad, but you just got to point to the fact that people are employed and they're spending. They're spending in the holiday season, which is where the bulk of spending gets done. Cash flows at corporate America, outside of technology even, are extraordinarily high, which means nobody's going to be laying off anybody anytime soon. The idea that the market is rallying because the ISM survey was weak is, in my opinion, exactly wrong. This is a condition that we're in the markets where good news is good news and bad news is bad news. The reason the market's rallying despite the ISM surveys is because we know that consumers have to date been traveling and enjoying experiences, but they are now currently shifting to buying again as we get into the holiday season. So I would expect that ISM manufacturing to reflect that as we get into the new year. You look at where corporate profits are, you look at where valuations are outside of technology, and it gives a very strong reason for this rally to broaden and the rest of the market to catch up with where tech is without having tech come down.